Well, in a sign that fear is fading from the markets, investors are no longer demanding a heavy premium on some of the bonds that Wall Street firms sell. Alan Braitman has a little bit more on that story from the newsroom. Alan.
Hey there, Deirdre. That's right. The background is that stock plunge ahead of the collapse of Bear Stearns, then Lehman. Rates on overnight loans between banks surging because the companies wanted to hold on to their money. That was last fall. And investors had demanded Wall Street firms pay them so much more on the bonds these companies were issuing compared to treasuries, essentially demanding junk yields. So here's what's happening now. Bondholders taking the smallest difference in the yields on bonds from Goldman Sachs and Morgan Stanley since before Lehman collapsed. Joe Balestrino is a fixed income strategist at Federated Investors. They manage $26 billion in debt. He says they're back on their feet. So if Goldman had to pay 10% to borrow for 5 years, that was the rate the market was charging back in September, it would struggle to generate enough revenue to cover costs. Today, the rate just under 5%, 4.79%. Goldman Sachs and Morgan Stanley, keep in mind, among 10 banks that last week paid back their TARP money. Also, just want to note, gains in shares of Morgan, Goldman, American Express, for example, helping an index of companies that receive TARP money outperform bank stocks this year. And Deirdre, that is a proprietary Bloomberg index I was just showing you. Back over to you.
Ellen, thanks very much.